are you?
Good, pretty good.
All right, so I'm just setting up the streaming. So I'm just waiting on YouTube to go, and it's fine. All right. Hello, everyone. My name is Darren Joseph from HJ.tax, and we're a team of cross-border tax advisors that seek to demystify the sometimes confusing world of international tax. And today we have the honor and the privilege of having an in-depth conversation with Senor Jose Aguilar Shea. Jose, would you like to introduce yourself, please?
Of course. Thanks a lot, Darren, for the opportunity, and obviously happy to chat about the Spanish Texas. So I'm a tax partner in international firm Squire Patton Boggs, based in Spain, in Madrid, Spain, and obviously was very used to working with international private clients, moving to Spain and planning ahead. So I hope we can make a useful conversation to anyone looking to move to Spain or having cross-border issues.
Fantastic, appreciate it. So I just want to jump right in and talk about the Beckham law. So it just, as an outsider, obviously it was designed with specific use cases in mind, but we found ourselves in situations where just like anybody moving to Spain, gets this company structured and uses it as a way to optimize their tax. My concern is, and tell me if I'm justified in thinking this way, if the company isn't actually doing anything functional, is there a risk that the Spanish tax office sees through the arrangement and sets it aside?
Definitely, Darren. I think it's good to make questions on this because, as you know, unlike other special tax regimes, Spain does have some specific requirements. It's not like the Italian or the Portuguese, where you can even go there and kind of retire or lay low and just have a special tax. The Spanish regime actually requires that you are linked to a Spanish employment contract or a director in a company. So as you point out, one of the potential risks that you have is like when you raise this to a client, they say, okay, don't worry, I'll just set up a company and become an employee at the company, right? Which I don't blame them, right? Everyone has to be creative. But and one of the arguments that we had with the authorities is that until last year, the company where you become an employee or a director cannot be owned by the individual benefiting from the regime or any family member. So now, in line with what you point out, now from 2023, the new rule improved this. We had a startup law, which one of the improvements to attract capital, attract investment, attract qualified employees, qualified businesses, was to allow individuals to move to Spain, set up a company, and become under the Beckham law within their own company. So this is an interesting point. And to your point, where we had some anti-abusive or abusive situations, they said you can benefit from the special tax regime in a company that you set up on your own, provided it's not what we call an asset holding company, which means that it operates a business activity. So that's where we come. How far can we go? Can I just buy a house and rent it out? Well, that's not actually a business activity, right? Then we go to the case by case, right? If you open up a restaurant, you have 10 employees and you become your director of that, that's fully valid. Do we need a mining company? No. Can real estate be applicable? Yes. But it needs to be an active business in the wide context, right? Where you have people working, you have substance, you have an active business, right?
Okay, so just to kind of quickly summarize, so before this, well, I guess this is part of what's commonly known the digital nomad regime. So before that, yes, the Beckham law was probably the only game in town and there was some risk associated with it. But now that you have this new regime that kicked in this year, you don't need to take those risks. So you can own your company and you can set that up once it's operational. It's not passive.
So the point is that we've seen structures where you say, well, don't worry, I could find someone to hire me. And then right now, currently, I'm in a tax inspection where they're claiming, okay, you were a taxman, but you're a high net worth individual. Let me see proof of your employee. So because the fact is that we haven't had that much scrutiny of the tax authorities around this regime, but lately we've seen a lot more, let's say, aggressiveness, just trying to, prove that that's an actual employee. But that's the standard abusive situation that you can have. The only thing where they kind of relaxed the situation now is that before you can see people that set up a company. No, okay, I have a friend that's hiring me. That's where it could get complicated. So now they said, no, straightforward. You can set up your own company. You can set up your own business. The only thing, it needs to be an active business. So that's where it kind of opens up a lot more opportunities for creation, which are not abusive. So the only risk that you have at hand is that it's not an active business. So you're not able to set up a company, become a director, and not do anything, because that, or buy a house and live in that house. That doesn't work, right? It has to be an active business in the broad concept of, as I said, a business operation.
Right. And in terms of industries that the tax office would look for, they'll look for, I don't know, contracts, supply arrangements, just there's some normal things that you would expect to have in running a company, right? As evidence.
That's it. Right. Again, there is a new regime that applies under what you said within the nomad visa and other beneficiaries, properties that were approved on that. But again, I think it's what you would standardly understand to running a business, and that would allow you to become under the Beckham law and no issue. Yeah.
Okay, wonderful. Another tax planning tool that I hear about a lot is the PPLI, the private placement life insurance. Are you familiar with that as a pre-immigration planning tool for moving to Spain? If so, how effective is it?
Yeah, I mean, I don't know if you refer to the Unilink that they've seen. I mean, there's a way that, that it's kind of a deferral situation where you put the money within insurance, and then at the end of the day, you try to exclude the impact on inheritance tax or in wealth tax. There has been some amendments on that, because that was a classic planning which was sold in a while, especially in Latin America. And now it has lost its beneficiaries within the wealth tax. And it right now works as a mechanism as tax deferral when you don't want to be able to pay taxes on any income that it comes through. But again, when you're in the Beckham law, you don't actually need that, because you're going to be in tax on your Spanish source income and Spanish wealth assets. But that is a situation where some people cannot benefit from the special regime. You're able to somehow defer the taxation. And actually this morning, I was just with a private client trying to find ways to kind of minimize the wealth tax and the income tax going forward. And there's some mechanisms that apply within, as you said, the private placement will work. And there's others that we can also comment on.
Right. So the PPLI can work for the wealth tax. And I guess generally for estate planning as well, given the forced heirship rules. Is that a legitimate way of getting your assets to the right person that you want to get it to in your family?
Yes, I mean, historically, Spain has been a lot more straightforward, because we don't recognize we're not part of the Hague Convention of Recognition of Trust. So the tax authorities have been direct that under a trust structure, those are considered tax transparent, and either it's, let's say, the assets are allocated to the beneficiaries if it is deemed to be considered as a gift to the beneficiaries from the settler, or if the settler is also the beneficiary that the trust has taken is not incorporated, right? So the way that it was done, it was in a way that you can set up like family-owned businesses, you can set up this insurance, you can set up, again, there's a way that you were mentioning that there's other ways with private foundations. But historically, we've been pretty reluctant to do that, because the ways that the classic private foundations were in Panama or Liechtenstein. Liechtenstein is a tax haven, Panama as well. And they have been used historically more for hiding cash at the time, right, in the 80s, 90s. So the tax authorities steer a little bit reluctant on those type of structures. And now we're seeing that less effective when you're trying to kind of exclude the impact of wealth tax and income taxes.
Okay, so in other words, private foundations don't work.
I mean, we can work it, but not as much, because then there was we've set up again, they would work, but not, let me put it this way, when not the whole family moves to Spain. So I'm going to explain, for example, what we did, for example, for the US, we had a Colombian individual owning a $60 million house in Miami, and they obviously moving to Spain would have an impact potentially in wealth tax, depending. It would also have an income allocation and a presumed income. So what they said, well, I don't want to give it to my heirs yet, so I want to put it in a U.S. trust. So they put the property in a U.S. trust. What we kind of managed to do as well, we have to do some type of acknowledgement from a U.S. tax perspective that would not be considered as a transfer of the property, but we could defend from a Spanish purposes when the beneficiaries, the heirs, are not resident in Spain, that they kind of, the way we found out is doing an acknowledgement by the beneficiaries. So we can consider that from a Spanish tax perspective, she actually transferred the property to the heirs. And so therefore it would move out of the property of the settler. Let's put it that way. But when you have the beneficiaries in Spain, it wouldn't work because it would be considered as they already are the owners of the assets. But again, when it's classic American families where we have one part or the other, let's say the heirs, the trustee, or the beneficiaries, we can kind of plan ahead using these type of vehicles that usually it wouldn't come for family that are fully established in Spain to set up a trust, private foundation. That's not something that we would have a classic planning for purely Spanish families. For Spanish
so generally speaking, a way of, let's say, mitigating the wealth tax is to hold these foreign assets in a structure, generally speaking?
Yes, when the beneficiaries of such structures are not
in Spain. Gotcha. Okay.
And just, I mean, to make the story brief, but the fact is that the way we've tried to face this, we've had a lot of discussions with the tax authorities. Spain just doesn't recognize this trust. And to be frank, they deem that the trust as an abusive historical ratio, where, again, now I think nowadays they're trying to understand that trusts are just estate plan succession planning. It may not have anything to do with trust plan, with tax plan. It's just a succession plan. So the way we can structure that is the way that we can consider that we pull out these structures out of the person, the individual, and we pull it out of the wealth tax filing for that purpose, right? Because from a Spanish tax perspective, we can consider, let me put it this way, from a pure civil perspective, that the ownership is not within the settler. So we can work around the trust structure to understand where, from a pure civil perspective, what the tax authority says that we do not recognize trust, which this means that the ownership is at the level of the settler or at the level of the beneficiary. So what we try to do, build from a civil law perspective, is what is the concept of ownership, right? So we go to the civil law and say, well, we have to determine whether the ownership is in the level of the settler or the beneficiary. Something that from an Anglo perspective, it doesn't make sense because we're claiming, no, the ownership is with the trust. But that doesn't work in Spain. So we're trying to say, when we don't have one of the parties, who are we trying to attract the property from a Spanish tax perspective? To the beneficiaries or to the settler? So that's where we kind of able to work around these rules in Spain.
Okay, so but generally speaking, a trust is looked upon as an abusive structure, and
that was more the historical structure. Now I think we're commonly, it's not used by Spanish families yet. It's not a common, but again, I mean, international movement, the globalization, we have a lot of families coming through. So I mean, so that's no issue. And again, we do have CFC rules, which, as you understand, they're demallocation of income, and that sometimes are penalized because they have a higher tax rate. But since trusts are purely tax transparent, the trust income would be directly allocated as capital income. So that could work. I mean, we can live with them. It's just that it would, but usually it's not something that a Spanish resident would set up. It would be something that would be planned ahead in the, let's say, the source country where the person is coming from, right? So we can live around them, but they're not that used to for Spanish.
And what about private trust companies? Similar?
Yes, I mean, the only difference is with, let me put it, what we call the private foundations, is that the Spanish tax authorities have made a differentiation that private foundations do have legal personality. So they have accepted that these foreign foundations are able to be considered as legal ownership of assets. The problem that we have here is that depending on how it's structured, they could be, it could be a higher tax burden. Let me put it this way. We are considering that we transfer the assets to a trust. That's not possible, but we transfer the assets to a private foundation. The problem is that then when the private foundation transferred to the beneficiary, it is considered as from a non-kingship owner transfer. So that means that when you have, let's say you have beneficial tax treatment for direct kingship ownership, transfer of assets from parents to a daughter, between spouses, that has a more beneficial tax regime from an inheritance perspective. But if we consider that there's been a transfer from a person, from let's say the father or mother, to a private foundation, and then the private foundation to the daughter or son, then there's a negative tax impact, whether it would have gone directly from the father to the son. So then we have to be careful on how we structure. If, again, that works, if we transfer the property and then the beneficiaries are not resident in Spain and then they receive it under a different structure. But otherwise, if the heirs are resident in Spain, there would be a worse tax treatment. So that's why it would be tricky to work that around, right? But we can, from a wealth tax, it could work because we can transfer the property outside of the individual.
Right. And I guess what makes it more complicated, as you pointed out earlier, a lot of these structures are available in so-called non-cooperative or blacklisted jurisdictions for Spain. And therefore, you have that additional layer of complexity to deal with, which is, not something you want. Okay.
There you go. That's it.
Gotcha. Okay. Onto something more vanilla. So many clients intend to retire in Spain, so they may be getting some sort of social security from the US or private pension or public pension. How is that looked upon and treated from a Spanish tax perspective, generally speaking?
Yeah, so the pensions received from a foreign country are generally taxable as employment income. If there's a general basis, and without going into detail, we have two separate tax baskets. The first basket is let's say the general income, what it's called, which includes employment income, real estate income, image income, royalty income. And then we have the capital income, which we call the savings base, which is basically dividends, interest, and capital gains. Okay. We don't have a difference between long-term capital gains and short-term capital gains. We did at the time, but currently we don't. So that is, let's say, tax. The first basket, which is the general income, employment income, is taxed from 45 to 50%. Even in some regions, it goes up to 54. And then the capital income goes from 20 to 28 with the latest changes, which was an increase to 28% in excess of 300,000 of capital income per year. Right. So that's how the baskets are applied.
Now, I was led to believe that if someone, while let's say they were back in the US, they were working for the government, and therefore their pension is pursuant to government or state employment, then potentially under the double tax agreement, it'll be taxable in the US, but not taxable in Spain. Am I misunderstanding?
Yes, that is correct, Darren. The tax treaties do provide some special rules on taxation, source taxation of the origin of pensions. So generally, the pensions are usually only taxable where the residency source, but there's some public specific pensions that could be taxed only at source. So there's no double taxation. And just by curiosity, Darren, just because I think it's a curious point, that as you know, Spain, the southern part of Europe, is an attractive place to retire. So we've had there is a curiosity where, for example, the Spanish-Danish tax treaty provided exclusive taxation right at the residency. So there was an interesting point where there was a bunch of Danish retirement people moving to Spain and France, whereby all the money that didn't pay taxes in Denmark was then being taxed in Spain and in France. So unilaterally, the Danish government canceled the Denmark tax treaty and the France-Denmark tax treaty because they wanted to change that, and neither Spain or France allowed that. So it's curious where Denmark and Spain have tax treaties with all the European unions, and same for France. The only one we don't have is with Denmark, because there was that situation where the Danish tax treaty is pretty old and it only provided exclusive taxing rights at the residency country. So Spain was taxing pensions coming from Denmark, which again, Denmark had the right to claim that, well, I gave a tax benefit for all those pensions that were placed privately and didn't pay taxes in Denmark. Now these people are moving to Spain and Italy and France, and they're not paying any taxes in Denmark, and Spain is benefiting from that. So that was the discussion. But as you point out, there are some ways that, because of the tax treaty, could allow exclusion of taxation for certain pensions.
Okay, understood. So generally speaking, so we're saying that if someone is coming from, let's say, a common law jurisdiction, that, things like trust may not be as efficient. So if, unfortunately, sometimes clients come to you with, bad habits, they already have structures in place. So you need to try and work with what they have. But if someone came to you like clean slate, they have nothing at all, what are the tools that you would normally pull out of your toolbox to work with them and that you find to be very helpful, generally speaking?
Yeah, so I mean, the ways that we can have, let's say we don't benefit from the Beckham law and we're able to apply, let's say, I mean, the most concerning what I'm seeing, obviously, it's that income tax. I mean, you kind of end up paying income tax anywhere, and we can accept that. I mean, there's Dubai, there's others, but the most difficult situation to go around is to understand wealth tax, right? Because wealth tax doesn't make sense, right? I made my wealth. Why am I paying you for having my wealth, right? I'm already paying income tax, it's a double tax. Spain is the only few countries that still has it. I mean, just so you have a brief background, the wealth tax is kind of allocated to each region. So until last year, like for example, regions as Madrid, Andalusia, or Galicia didn't have wealth tax because it was fully, there was a 100% rebate on the tax, so it was tax free. But again, to avoid that discussion between the regions, that have so much different taxation, the federal government, the central government decided to approve an exceptional wealth tax on a federal level, which only applied in those regions that actually didn't have a practical wealth tax. So again, there's ways that we can work around that. For example, one of the points that I think it's worth is if family-owned businesses, family-owned companies that actually are active within the individual or the family would be excluded from the wealth tax computation, right? The calculation. So that's important. If you have family-owned businesses, your ways to structure that are saying a U.S. person still owns a business, has a business which is worth 20 million, 50 million, whatever. If it could be planned ahead so that that asset, that business doesn't account for the wealth tax calculation.
Right.
And just to make a small, a relevant point here is that within this special tax that applies for worldwide assets, now there's also a way that if you have, the point on wealth tax is that it's a higher income tax burden. But the point that they raised is if you have, let's put it the situation, you have lower income because you're retired and you just have a small pension, but you have this big wealth, you're able to minimize your wealth tax exposure down to 80% reduction. So this means, let me put the example. What are the Spanish authorities trying to avoid? Let's say my only asset is a building which is worth 10 million.
Yeah.
And you can get to a situation, but I have no income. So let's say I have to pay 200,000 in wealth tax, but I don't have any income to pay that. So it doesn't make sense that you penalize that as well. So what they said is, well, there's no zero tax, but I'm able, if you're low income, you're able to reduce your wealth tax exposure down to 20%, which is very interesting. So, and again, now you say, well, but I have more assets, I have financial assets, I'm receiving capital income. Okay, so that's what we would have. How can we benefit from this rule? That we allow to have investments, not direct investments, but you apply funds. And you know, it's very common in Europe that we have a special funds transfer regimes where there's no taxation, right? So reinvestment schemes. So if you, instead of buying bonds and receiving monthly coupons or quarterly coupons, if you can have a fund that invests in fixed income, capital, whatever you want, but you're only taxed when you pull the money out. So that means that your actual income is zero. You have your wealth attributed in different funds. So that's the way you can plan. Instead of having your individual investments, you can do a planning to investment funds. You have UCITS, you have other ways of benefiting from that from a regulated perspective, the CCABs and other vehicles, but that's a way so you can minimize the wealth tax exposure.
Right. Unfortunately, they may be PFIX from a U.S. point of view for those who may be U.S. exposed. But what about the asset protection side? What typical structures do you have, or would you recommend, and would you work with your clients in terms of asset protection?
Yes, well, I mean, again, we still find that sometimes, I mean, we do see, and especially with Latin Americans and North Americans, they still want to have their asset protected within the U.S. They have Latin American would still want to have some I mean, I do feel that Spain works in the common market, the European Union. So sometimes you feel, well,
Mhm.
if you don't trust Spain, I'd rather have it in Luxembourg and Switzerland. That still
Yeah.
work. There's
Mhm.
no issue. We have no limitation assets abroad. I mean, you might have
Mhm.
heard that there is an additional reporting for foreign assets. So
Mhm.
I mean, that's something that just an additional reporting. But other than that, and as I said, I would be fine working through a trust structure for a pure
Mhm.
asset protection, right? Or
Mhm.
succession planning. Again,
Mhm.
what I've seen is that, for example, a US person came into, if you do a BVI trust, Cayman trust,
Mhm.
Bermuda
Mhm.
trust, Bahama trust, that could be
Mhm.
seen as a more aggressive, abusive. I think there's ways to explain it. You can be fully transparent, disclose that. That's fine. As I said, US trust would work perfectly. So again,
Mhm.
what would we do? We would have full disclosure of the trust. Okay, the trust, I have a trust for succession planning, but for
Mhm.
tax purposes, I'm
Mhm.
allocating directly the income that
Right.
I have in the trust. That's fine.
Mhm.
I want to set up a
Mhm.
blocker entity because I don't want to have the US state tax problem. That's
Mhm.
fine. I mean, we were going to do the full disclosure of the tax
Mhm.
transparent vehicle, and that's fine. And again,
Mhm.
I mean, there is full flexibility, and as you said, risk allocation is different for every client. So
Mhm.
there's ways that you can accommodate to that. And people, as you said,
Mhm.
they trust US, they trust Switzerland, they don't trust Spain, they don't trust Latin America, and this changes. Again,
Yeah.
that's
Mhm.
how we could work around that, and I think
Mhm.
that's pretty flexible. We're in a safe environment from a European perspective. As you know,
Mhm.
there's a minimum 100,000 a protection on any asset within the European Union. Every
Mhm.
bank that you have in a deposit is
Mhm.
protected within the
Mhm.
European
Mhm.
Union. So I mean, sometimes right now in Spain, higher uh, you have people are putting 100,000 in Spain. They're putting a hundred
Mhm.
thousand in a Lithuanian bank because
Mhm.
it has higher yield, just because there's
Yeah.
a higher risk. But at the end of the day,
Yeah.
the
Mhm.
European Union is protecting up to 100,000 in any bank around the European Union. So
Mhm.
that's where now we have different products that people are investing.
Mhm.
Again, weird investments in Lithuania or someplace or Bulgaria because that
Mhm.
they have a higher yield of investment. So again,
Mhm.
the risk is free, right?
Mhm.
In a way.
Okay. And speaking of neighboring European jurisdictions, obviously you would have heard that the government in Portugal intends to get rid of their NHR, non-habitual residence program. I would imagine that this, everyone in Spain is doing like this. Yeah, okay, come on over, right? Is that what you think would happen? What is your perception or your thoughts on the impact of what's happening in Portugal?
Yes, I mean there has been also some mentions here. I mean, I think that the
Mhm.
Portugal has had really specific focus on the fact that the real estate properties have gone really high. And I
Yeah,
mean, I can say Portugal is really centralized probably in the Cascais, Estoril, or in the south.
yeah.
So, and it's a smaller market, has
Mhm.
attracted a lot of impact, a lot of special regime. So I think it did make a negative impact on the local market, or that's how I think locally is seen by the left wing, because
Right.
I mean, it was always seen as we're bringing all these rich people, are raising the prices, are raising the
Mhm.
properties, are raising, which eventually was good because it's an investment. But at the end of
Mhm.
the day, it's making the standard of living for normal Portuguese higher. I
Mhm.
don't think we've ever had that perception in Spain just because
Mhm.
I guess our coast is bigger, we have a bigger
Yeah.
market, and
Mhm.
we haven't seen the price. I mean, you do see that there's a lot of Latin Americans, a lot of Chinese, a lot of American, but in a 50 million individual country, it's
Mhm.
not that big. And Portugal has
Mhm.
become a really important share of what's the total market of 11 million of Portuguese. And
Mhm.
again, the fact that as you see nowadays, any politician is looking at any tax measure as a
Mhm.
social point of view. And
Mhm.
again, we've always had the Beckham law, and even the
Mhm.
incorrectly named Beckham, which I'm reluctant because no one ever called it Beckham. It just was approved
Yeah.
when Beckham was hired from
Yeah.
Manchester to Real Madrid. But
Yeah.
again, we've always seen to attract capital, attract high qualifying. Now, I mean, let me say, high net worth individuals are not able to benefit to retire. Sports persons are not able to benefit from that anymore, and it's
Mhm.
really allocated to high quality individuals, high qualified investment.
Mhm.
Obviously, it has allowed other peoples to benefit from it, But and again, I say a proof of this is that the tax regime has been improved as part of this new regime applying from 2023, within attracting, as you said, the nomad visa, which is within approving an entrepreneur's law and a startup law. It was improved, and now you can set up your own company and come here. So again, I don't see it going away. I don't think the impact is that much, and it is a way of attracting high capital. I know everyone sees that high net worth individuals going to, but you are attracting people that are setting up businesses. That's the intention of the law. I mean, it's high qualified employees moving to Spain now in the nomad, in the digital era. So people are coming here to work for Amazon in California, and they're working from here. And they're just paying 40%, instead of paying 40-50% that you pay in California, you're paying 24% flat tax. It's only for 4 years, and it's capped at 600,000. So again, if you have people making 5 million, you're still going to be paying the 45% tax. So I don't think it has that negative press that I think about in Portugal. So if you ask me, I don't think it's going to go away. It's here to stay. And I don't think we have a negative view within Spain that it's having a negative impact to us. They've made changes through the years. They took a sportsman where, again, sports people were paying less taxes than normal employees. But again, just so you have the aware, 45, the tax rate is already 45 for anyone making over 60,000 euros. So we do it. I mean, the higher 48, 50% goes from 300,000. But in Madrid, for example, anyone making more than 60,000 is paying 43%. In other regions, 45. So people with average salaries with between 60 and 150,000, which is the mid-high class in Spain already, they're paying that high yield. So that's not something that it's really hitting the Spanish system in a way.
Gotcha. That's good to know. Jose, thank you so much for your time and providing your insights. If someone wanted to find you and reach out to you, what's the best way to reach you?
I mean, obviously I could share. I don't know if my email. You can look me up online, Jose Aguilar Shea in Squire Patent Box. My full details are in our webpage. Obviously, happy to share my email. But obviously, you can always find my name and number in Squire Patent Box Madrid, and obviously happy to assist. And if they have any questions, we have our contacts. So of course, Darren, happy to work together or to in any case with clients, or try to give it that first call and advice on whatever they need.
Wonderful. Thank you very much. Appreciate it.
Thanks a lot. Pleasure to everyone. Happy to help.
Okay. Take care. Bye-bye.
Take care, Darren. Bye-bye.
All right. It's off. All right. So we're good. Appreciate it.